It's like usually when we talk about a medical diagnosis, there's this expectation of just absolute precision.
Right, like it's a science.
Exactly. It's like engineering.
Yeah.
You break your arm, you go to the hospital, and the X-ray shows that jagged white line right on the screen,
Yeah.
and the doctor just points at it.
Right, it's broken or it's not.
Broken or not broken. It's this clean, totally visible reality.
And, that gives us a sense of control. We want things to be visible. We want to categorize the problem so we can apply a really specific solution to it.
But then you step into the world of the stock market, and suddenly that X-ray machine is just, it's completely useless.
Yeah, completely.
We're looking
Yeah.
at this financial landscape that is notoriously murky. You see the stock market crashing, right? Like red numbers flashing across every single screen. People's portfolios are bleeding value.
Total panic.
Yeah, and the financial news networks are just desperately pointing at the surface level stuff.
Yeah.
They talk about, disappointing earnings reports or macroeconomic headwinds.
Geopolitical tensions. Yeah, they love that one.
Right. They act like the market is this perfectly rational weighing machine that, perfectly reflects the news of the day.
Which is such an illusion. I mean, they're pointing at the symptoms, but they are completely blind to the underlying mechanical failure that's actually driving the collapse.
And that realization is exactly where we are going today. We're taking a massive stack of highly technical research. I'm talking deep quantitative finance, market microstructure, the legendary Black School's Merton model.
The heavy stuff, yeah.
Really heavy stuff. But we're going to strip away the complex calculus. We're going to look at the actual gears and pulleys moving the stock market beneath the surface.
Which is so needed.
It is. And I want to speak directly to you listening right now, whether you are, a casual trader just holding a few shares of Amazon in a retirement account, or maybe just someone who is insanely curious about why markets seem to suddenly free fall out of nowhere while the news anchors look totally bewildered.
They really do look lost sometimes.
They do. So this deep dive is going to give you that X-ray vision.
And it genuinely changes how you perceive price movement. Like once you see the market through this mechanical lens, those traditional narratives about bulls and bears fighting over fundamentals,
Yeah.
they start to sound like fairy tales.
Because the hook here, and this is the thing that absolutely blew my mind when I was reading through these sources, is that during a market crash, the price action often has absolutely nothing to do with whether a company is profitable or failing.
Nothing at all.
Right. It is driven by a mathematical death spiral, like a forced mechanical chain reaction that is literally programmed into the trading algorithms of giant institutions, the market makers.
Exactly. The news doesn't cause the crash. The math causes the crash.
Okay, let's unpack this because, how do we even begin to understand these hidden forces?
Well, we have to start at the absolute foundation. If we want to understand how a massive financial skyscraper collapses, we have to understand how the steel in the framework is forged.
Okay, the basics.
Right. And in our case, that means understanding how options are priced. Which brings us to the Black Scholes Merton model.
Also known as BSM, right?
Yeah, BSM.
So this is the Nobel Prize-winning framework, and from what the sources detailed, this model essentially transformed finance from, alchemy into a rigorous mathematical science.
And that's really not an overstatement. I mean, before 1973, pricing an option was basically the Wild West.
Really? Just guessing.
Literally, you had guys in suits on a trading floor relying on gut feeling, looking at, historical charts and just taking wild guesses. It was an incredibly inefficient market.
Wow.
So BSM changed the world because it provided, for the very first time, an actual mathematically sound price tag for risk.
Okay, but before we get into the model itself, let's establish exactly what we're even pricing here. For the listener who might only buy regular shares of stock, what is an option in the simplest possible terms?
Yeah.
Our sources give this fantastic real-world analogy that takes it totally out of the Wall Street jargon.
Yeah.
Imagine you are a huge Apple fan, and you know they're launching a revolutionary new iPhone next month, but you are terrified that the hype is going to drive the price through the roof and you won't be able to afford it.
Classic supply and demand.
Exactly. So you go to a local electronics store owner and you strike a really specific deal. You hand the owner a $10 deposit today.
Okay.
In exchange, the owner guarantees you the right, but crucially, not the obligation to buy that specific iPhone next month for exactly $5,000.
Right. Let's break down the terminology in that scenario because it perfectly maps to the stock market. That $10 deposit you paid out of pocket,
Yeah.
that is the option premium. And the $5,000 price tag you locked in, that's your strike price.
Okay, so let's play out the two scenarios here. Scenario A, the new iPhone comes out, it is a massive hit, and there's a global
It
shortage.
happens all the time.
Right. And the phone is suddenly selling for $6,000 everywhere else. Because you have that contract, you get to exercise your right. You buy the phone from the store owner for the agreed $5,000, and you instantly have a $990 profit.
Which is a massive return on investment considering you only risked $10 to secure the deal in the first place.
Exactly. But then there's scenario B. The phone is a complete disaster.
Terrible reviews.
Terrible reviews, no one wants it, and the market price drops to $4,000. Now, if you had pre-ordered the phone for $5,000, you'd be losing money.
You'd be underwater.
Right. But because you only bought an option, you just walk away. You literally throw the contract in the trash. You don't have to buy the phone, and your total loss is strictly capped at that $10 deposit.
And this highlights the defining characteristic of an option. It's an asymmetric payoff.
Meaning
Your downside is strictly walled off. Like the absolute worst thing that can ever happen is you lose your initial premium, but your upside is potentially enormous. And that brings us to the core problem that Fisher Black, Myron Scholes, and Robert Merton were really trying to solve. How do you determine if that $10 deposit is a fair price?
because you're trying to price the unknown.
Exactly. When the future is completely unknowable, how much is the right to a future transaction actually worth today?
So according to the DSM model, you don't need a crystal ball to figure that out. You just need to look at 5 specific variables. The sources call them the 5 kings of pricing.
Yeah, 5 distinct, totally measurable factors.
Okay, lay them out for us.
First, you need the current stock price, which the math labels as S. If the stock is currently trading very high, a contract to buy it is obviously going to cost more.
Makes sense.
Second, you need the strike price, or K. This is that agreed-upon future transaction price. The difference between the current stock price and the strike price dictates how far the stock has to move for the option to be profitable.
Right, so if Amazon is trading at $200, an option to buy it at $210 is going to be cheaper than an option to buy it at $205.
Because 210 is further away, it's a much harder hurdle to clear.
Exactly. Okay, what's the third?
The third factor is the time to expiration, represented by key. If you give an option more time, you are giving the stock more room to experience a massive, unexpected move.
So a contract that expires tomorrow is cheap because, frankly, almost nothing is likely to happen in 24 hours.
Right. But a contract that expires in 2 years is incredibly expensive because a company could cure cancer or, go completely bankrupt in that time frame.
So time is literally opportunity.
It is.
What are the last 2 factors?
The fourth is the risk-free interest rate, or RO. This represents the basic cost of capital in the economy, usually tied to government bonds.
And we'll see why interest rates matter so much when we get into the hidden debt of options later.
Oh, absolutely. And finally, the fifth factor, and arguably the most critical one in modern trading, is volatility, represented by the Greek letter sigma.
Volatility. So this is basically a measure of how violently the stock price swings back and forth, right?
Yes.
And this is where options diverge completely from traditional investing. Because if I'm buying shares for my retirement account, I generally hate volatility. I want a nice, steady, predictable line going up.
Of course.
But if I'm buying an option, volatility is like my best friend.
It is the engine of the asymmetric payoff. Think back to the downside protection we just talked about. If a stock drops 1% or if it drops 50%, your option becomes equally worthless.
Right. My loss is capped at the premium either way.
Exactly. The magnitude of the drop doesn't hurt you more, but on the upside, the magnitude absolutely matters.
Because if it jumps 1%, I make a little. But if it jumps 50%, I make a absolute fortune.
Yes. Therefore, the wilder the swings, the higher the volatility, the greater the statistical probability that the stock will experience a massive upward spike while your downside remains safely locked.
Okay, so those are the 5 kings: current price, strike price, time, interest rate, and volatility. Now, the sources show the actual mathematical formula that ties these all together to price a European call option.
Yeah.
And I want to pause here because when I first looked at the structure of this equation, my brain just stopped.
It's notoriously intimidating to look at.
It's terrible. So I'm going to try to describe it conceptually because reading the calculus aloud is just terrible radio.
Please don't.
The formula basically says the call option price equals the current stock price multiplied by some complex probability factor minus the strike price multiplied by another probability factor and an interest rate discount.
It's the basic shape of it, yeah.
But here's the thing that really tripped me up. The major pushback I had when I was trying to understand this,
Okay.
if an option is an agreement about a future transaction, and we're trying to calculate the future expected return, why does the entire BSM formula anchor itself to the current stock price today?
That's the big question.
Right. Like, why aren't we projecting the future price of the stock and then discounting that future value backward?
That is the exact conceptual hurdle that every single finance student hits when they first encounter BSM.
Really? It's not just me.
Not at all. You are intuitively trying to use the formula as a crystal ball. You're looking at the math and asking, where does this say what the stock will be worth in a month?
Yes, that's exactly what I'm looking for.
The BSM model doesn't predict the future. It doesn't even try.
Wait, it doesn't care about the future at all.
Not in the way we traditionally think of prediction, no. Instead, it does something far more profound. It creates a recipe.
A recipe.
It creates a set of instructions for what you must do today. This is the absolute genius of the model, and it's known as the replication principle.
Okay, the replication principle. I need you to break that down for me because this seems to be the key that unlocks the entire options market.
It really is. The creators of the model realized something incredible. They realized that you can perfectly mimic the exact financial payout of an option without actually using an option contract.
Wait, how?
If you combine buying the underlying stock with borrowing cash from a bank in the exact right proportions, you can synthesize the exact same profit and loss profile as the option.
You can basically manufacture an option out of raw materials.
Yes. And here's the logical breakthrough. If a synthetic option made of stock and debt gives you the exact same payout as a real option contract, then the fair price of the real option contract must equal the current cost of that stock and debt combination.
Because if they didn't match, the market would break.
Exactly. If the real option was cheaper, people would buy the option and sell the synthetic combination to make a risk-free arbitrage profit.
Free money.
Right. And if the option was more expensive, they would sell the option and buy the synthetic mix.
Okay, I want to map this concept to something deeply physical so you listening can really see it. Let's use the analogy of buying real estate.
I love this analogy.
Let's say you want to buy a house,
Mm-hmm.
and the house is worth $1 million. That $1 million is our current asset price. Now, almost nobody pays $1 million in straight cash.
Very true.
What you do is you put down a deposit, let's say $100,000 out of pocket. And to cover the rest of the purchase price, you go to a bank and you take out a mortgage, borrowing $900,000.
That is a brilliant framework. So let's apply the BSM formula to your house. The BSM formula is essentially just a balance sheet for that transaction.
Okay.
The first half of the formula, the part dealing with the current stock price, represents the total value of the asset you are buying. It's the $1 million house.
Right.
In the options world, the formula tells you exactly how many shares of stock you need to hold to mimic the option. This ratio is called delta. So if the formula says the delta is T to 5, you need to buy half a share of stock for every option contract you're trying to replicate.
Okay, so that first chunk of math is simply the asset side of the ledger. I own the house, I own the stock.
Yes, but as you noted, you didn't buy that asset with 100% of your own money. An option gives you massive leverage.
Right, just like a mortgage.
Exactly. You control a large amount of stock for a very small premium, just like you control a $1 million house for only $100,000. To simulate that leverage mathematically, you have to inject borrowed money into the equation.
And that leads to the second half of the BSM formula, the part with this subtraction sign.
Exactly. The second half of the formula calculates the precise amount of money you need to borrow from the bank today at the current interest rate to fund that leveraged stock purchase. That is your $900,000 mortgage.
So the subtraction sign in the middle of this terrifying calculus equation is literally just calculating net equity. Value of the asset you hold minus the debt you owe the bank equals the cash you should pay out of pocket today. The premium.
It is breathtakingly elegant when you see it that way, isn't it?
It really is.
It takes this chaotic, entirely uncertain future where the stock could go to the moon or go completely bankrupt, and it reduces it to a shopping list you can execute right now. Buy this specific amount of stock, take out this specific size of a loan from the bank. If you do that, you have synthetically created an option.
I love how that strips away the mystique. It is just a highly dynamic, debt-fueled stock purchase.
That's all it is.
But here is where we need to introduce a massive dose of reality. Because the math is beautiful, But the sources emphasize that this elegance relies on a glaring, almost absurd assumption.
Oh, yeah. It is the most controversial part of the entire model.
Because if BSM is just this recipe of stock and debt, how does it deal with the messy reality of human psychology?
It struggles.
Right? The market is made of people, and different investors have wildly different risk appetites. A 22-year-old day trader throwing their disposable income at a meme stock does not evaluate risks the same way an 80-year-old retiree evaluates a utility stock.
Of course not.
Panic, greed, fear, these are real forces. So how can a single formula spit out one universally fair price
Yeah.
without knowing who is actually buying it?
Well, it can't. And that brings us to the model's brilliant yet fundamentally flawed central illusion: risk-neutral pricing.
Risk neutral.
Yeah. To make the math function, Black, Scholes, and Merton had to pretend that we live in a theoretical universe where absolutely no one cares about risk.
Wait. They literally built a foundational financial model by assuming investors are indifferent to risk. That completely contradicts the basic premise of all investing.
It absolutely does. The core tenet of finance is the risk premium. If you ask an investor to take on more risk, like buying a highly volatile tech startup instead of a super safe government treasury bond, that investor demands a higher potential return as compensation.
Right. I'm not buying a speculative biotech stock unless I think it might double or triple. If I just want a guaranteed 4%, I'll buy a bond.
Exactly. The riskier the asset, the higher the expected growth rate has to be to attract capital. But the BSM model erases that distinction entirely. It assumes a risk-neutral world where all assets, regardless of how wild or stable they are expected to grow at the exact same rate, the risk-free interest rate.
Let me challenge this, because this feels completely disconnected from reality.
Go for it.
This is exactly like a high school physics problem that starts with the teacher saying, assume a frictionless vacuum and no air resistance.
That's a perfect analogy.
It makes the math work perfectly on the chalkboard.
Hmm.
You can calculate the trajectory of a feather and a bowling ball falling at the exact same speed. But if you step out of the classroom and jump out of an airplane, air resistance is going to matter.
You matter a lot.
You cannot just wish away human fear. In the real world, panic is a tangible cost, and people absolutely demand risk premiums.
And your instinct to push back is completely valid. It is physically, demonstrably false. People do care about risk. But here is the mind-bending twist.
Okay.
The assumption works for pricing options anyway because of the physical mechanics of the market makers. We need to go back to the replication principle.
Buying the stock and borrowing the money.
Yes. The giant institutions that sell these options, the market makers are not in the business of gambling. They are in the business of collecting fees and moving volume.
Right, they just want the spread.
Exactly. They do not want to bet on whether Amazon is going to go up or down. So the absolute millisecond they sell you a call option, their computer algorithms use the BSM recipe, they calculate the delta, and they immediately buy the exact amount of underlying stock needed to perfectly hedge the option they just sold you.
Okay, let's slow down and look at that carefully. I buy an option that makes money if Amazon goes up. The market maker sold it to me, so they lose money if Amazon goes up.
Correct.
To protect themselves, they go out and buy actual shares of Amazon. So if the stock goes up, they lose money on the option contract, but they make the exact same amount of money on the physical shares they just bought.
You've got it. The two positions perfectly cancel each other out. And this state of balance is called being delta neutral.
Delta neutral.
Yeah. And this is the magic trick that makes the frictionless vacuum work. Once the market maker has perfectly hedged their position, they literally do not care which direction the stock moves.
Because they're covered.
Right. If it rockets up 20%, they are neutral. If it crashes 20%, they are neutral. Their directional risk has been synthesized away.
Oh, I see. Because the market maker mechanically neutralizes the risk in the real world through their hedging activity, the risk premium is effectively neutralized too. The human emotion of fear is just removed from the equation because the computer has built a wall against it.
Yes, that's exactly it. Because the market maker no longer cares about the expected directional return of the stock, the expected growth rate and the discount rate applied to it are both forced to be the risk-free rate.
Mathematically, they just cancel each other out.
Exactly. This makes the math incredibly simple. The option price becomes solely dependent on volatility. The formula completely ignores how much a stock is actually expected to go up by, Wall Street analysts.
Because the expected return vanished from the math. Because it vanished from the market maker's risk profile.
Precisely.
That is fascinating. The math describing a risk-free fantasy universe becomes completely functional because the institutions build a synthetic fantasy universe around every single trade.
Beautiful,
But
really.
I have to imagine this frictionless vacuum breaks down eventually. I mean, air resistance always shows up.
Oh, and when it shows up, it causes absolute chaos. Because the market isn't a gentle, continuous curve. The BSM model assumes that prices move smoothly from like $100 to 101 to 102.
Right.
It assumes that if a market maker needs to adjust their hedge, they will always have time to buy or sell the stock at the very next incremental price.
But stocks don't always move like that. They gap.
Exactly. The model completely fails to account for fat tails.
Tails.
Yeah, black swan events where the market just plummets instantly. Or consider an overnight gap. A company closes at $100 on Tuesday. Tuesday night, they announce their CEO is being investigated for massive fraud.
Oh boy.
Right. Wednesday morning, the stock opens at $50. There was no 99, no 80, no 60. It just instantly teleported to 50.
And the market maker who needed to sell stock at 90 to protect themselves never got the chance. They're just trapped.
Totally trapped. Those gaps are where the BSM model faces its absolute darkest nightmares, and those traps are exactly what fuel the market crashes we are going to explore later.
Wow.
But before we move away from this concept of risk-neutral pricing and equity, the sources highlight an incredible extension of this logic called the Merton model. It applies this exact same options math to corporate debt.
Yeah, the notes mentioned this briefly. It says the Merton model proves that a company's equity, like the actual shares of stock you buy, is secretly just a call option on the company's underlying assets.
It's a really cool concept.
I need you to explain that because
Yeah.
thinking of a share of stock as an option kind of bends my brain a little bit.
It requires a shift in perspective, definitely, but it
Mhm.
makes perfect sense. Let's build a company together. You and I decide to start a manufacturing business. We put in $1 million of our own money. That is our equity.
Right.
But we need a massive factory, so we go to the bank and we borrow $9 million. So we now have $10 million in assets.
Okay, so we have 1 million in equity, 9 million in debt, and 10 million in total assets.
Now let's look at the payoff structure if the company succeeds. Let's say our business just booms. Our assets grow from 10 million to 50 million.
Nice.
We still only owe the bank 9 million. So our equity, our share of the pie, grows from 1 million to 41 million. We capture all of the unlimited upside. The bank only gets their fixed interest rate.
Right, that's why being a shareholder is way better than being a debt holder when things are going well.
Exactly. But what if the company fails? What if our product is terrible, our inventory is worthless, and the value of our assets plummets from 10 million down to 4 million?
Well, we owed the bank 9 million, but we only have 4 million in assets, so we are bankrupt.
We are. The company defaults. The bank steps in and seizes the remaining 4 million in assets. But what happens to you and me, the shareholders? Because of corporate limited liability, the bank cannot come after our personal bank accounts or our homes to get the remaining 5 million they are owed. Our equity goes to zero, but not a single penny below zero.
Oh, wow. I see the parallel now. We have unlimited upside if the assets grow, but our maximum possible loss is strictly capped at our initial $1 million investment.
It behaves exactly like the iPhone option we talked about earlier.
It really does.
You pay a premium, your initial equity, for the right to the upside of the company's assets, while the bank absorbs the catastrophic downside risk. The Merton model uses the BSM math to price corporate bonds based on this exact relationship. It's the same mechanical framework applied to a totally different part of the financial system.
Okay, so we have established this pretty profound reality. Buying a call option is secretly just forcing a market maker to execute a leveraged, debt-fueled stock purchase on your behalf.
That's the summary, yeah.
We understand the asset side of that ledger, but let's look closer at the debt side. Because in the real world, borrowing money is never free. Debt carries weight,
Heavyweight.
and that transitions us to exploring who actually pays the interest on that hidden debt, which introduces the concept of time.
This is where theoretical elegance meets the trader's wallet in a very, very painful way.
Let's get into it.
We know the market maker buys stock to hedge, and we know they borrow cash to simulate the leverage of the option. But where do they get that cash? They aren't using their own capital.
No.
No, that would tie up billions of dollars and be incredibly inefficient. Instead, they turn to the repo market.
The repo market.
Mm.
Repurchase agreements. This is like The plumbing of the financial system, right?
Yeah.
Where massive institutions lend each other cash overnight, usually backed by treasury bonds as collateral.
Yes, exactly. The market makers are taking out massive multi-million-dollar loans every single day just to fund the hedges for the options they sell to retail traders and funds.
That's wild.
And the banks lending that money are charging them interest. Every single day the meter is running.
So the market maker has this massive daily carrying cost.
And they certainly aren't going to absorb that cost out of the goodness of their hearts, you know?
Right.
They pass that cost directly onto the person who bought the option. This combination of the real-world interest cost on the borrowed money, combined with the shrinking probability of the stock making a profitable move as the clock ticks down, creates the force we call theta, or time decay.
Theta, the silent killer of the amateur option buyer.
It really is.
I think anyone who has dabbled in options has experienced this absolute frustration. You go onto your brokerage app, you buy a call option on a stock, you are absolutely certain it's going to go up.
Right.
And for a week, the stock does absolutely nothing. It trades completely flat. And yet you look at your portfolio and your option is bleeding value every single day.
It's maddening.
It feels like an arbitrary penalty, like the casino just taking a chip off your stack every time the roulette wheel spins.
It feels punitive, but it is deeply mechanical. Theta is literally the rent you are paying for the market maker's leveraged stock position.
Okay, right.
Yeah, if your trading platform shows a theta of negative 0.10 for your call option, that means your option contract is losing $10 a day just for existing. You are paying the daily interest on the debt the market maker took out to provide you with that leverage. You rented the house, and theta is the daily mortgage payment.
Let me ask a practical question about this, because this always confused me when I started trading. Does Theta charge me over the weekend?
Oh, yes.
Because when the market closes on Friday at 4:00 p.m., I physically cannot trade the option until Monday morning. Am I still paying rent?
You absolutely are, because the bank that lent the money to the market maker in the repo market doesn't stop charging interest just because it's a Saturday.
Of course they don't.
The time value of the option continuously decays over the weekend. Generally speaking, the opening price of an option on Monday morning, assuming the stock price hasn't moved a single cent and volatility hasn't changed, it will already reflect 3 full days of invisible weekend decay. Friday, Saturday, Sunday.
That is brutal.
Yeah.
You are literally paying for time you can't even use to trade.
It is the cost of leverage. But it gets even more dangerous.
How so?
A crucial nuance that a lot of traders fail to grasp is that theta decay is not linear. It is not a steady, predictable drip like a leaky faucet losing 1 drop per minute.
Okay.
In the BSM formula, time represented by T is fundamentally a countdown. It represents the remaining lifespan of the contract. And because T sits under a square root sign in the complex probability calculations of the formula, the math causes the decay to accelerate dramatically as expiration approaches.
It accelerates. Give me a visual for what that actually looks like.
Imagine you're piloting an airplane that has just run out of fuel.
Okay, terrifying.
When you are at 30,000 feet, you have a massive cushion of altitude, which is like having months of time left on an option. The plane glides relatively smoothly, the loss of altitude is gradual and, manageable.
Right.
But as you get closer and closer to the ground, the reality of the situation really sets in. Your options dwindle. The angle of descent becomes steeper and steeper until, in the final moments, the plane is practically just falling right out of the sky.
The ground is just rushing up to meet you.
Yes. If you are holding an out-of-the-money option in the final week before expiration, theta decay will absolutely destroy its value at an accelerating exponential rate. The rent becomes exponentially more expensive as the probability of the stock reaching the strike price basically collapses.
Which perfectly explains why trading those 0 days to expiration options, the 0 DTE contracts that are so ridiculously popular right now, is basically financial base jumping.
That's a great way to put it.
You are stepping off a cliff the exact millisecond you buy the contract. You're in free fall, and you need the stock price to make a massive, violent move immediately just to outrun the terminal velocity of the theta decay.
That is a perfect description. The theta is so aggressive on a 0 DTE option that you are fighting an incredibly steep uphill battle.
Okay, before we move on for the pricing models, I want to clarify one highly technical detail from the sources that feels really important for anyone actually trading these instruments.
Sure, what is it?
We keep talking about the BSM model, but the research notes point out that BSM was specifically designed for European options. What does that distinction mean, And does it apply to the stocks we trade every day on our phones, like Apple or Tesla?
It is a vital distinction that fundamentally changes the math. A European-style option is a contract that can only be exercised at the exact final moment of expiration.
Oh, interesting.
If you buy a European call option that expires on Friday at 4:00 p.m., you cannot choose to exercise it on Wednesday, no matter how much profit you have. You must wait for the finish line. The BSM formula relies heavily on this assumption. It maps a single, uninterrupted path from today to expiration day.
But the options I trade on my app, the options on Amazon, Nvidia, or Microsoft, those aren't European.
No, they're not. Options on individual U.S. stocks are American options.
And the difference is?
American options can be exercised by the holder at any time before expiration. You can pull the ripcord and demand your shares on a random Tuesday, weeks before the contract ends. You have the right to an early exit.
Ah, and the traditional BSM model doesn't account for the value of having that choice.
It ignores it completely. The flexibility to exit early has inherent value. It is an extra right granted to the buyer. If market makers use the raw, unmodified BSM formula to price American options, they would routinely underprice them.
Maybe leaving money on the table.
Exactly. They would be giving away that flexibility for free, and sophisticated firms would exploit that mispricing to siphon billions of dollars out of the market makers.
So how do they fix the formula? Like, how do they patch the model to account for this?
They use much more advanced, computationally heavy methods. The sources mention two primary solutions. The first is binomial trees.
Binomial tree.
Yeah. Instead of drawing a single straight line to the expiration date like BSM, a binomial tree maps out the probability at thousands of tiny time steps along the way.
Right. Checking constantly.
Exactly. It asks, if we stop on day 3, is it profitable to exercise early? If we stop on day 4, is it profitable? It calculates the value at every single node of the tree.
That sounds mathematically exhausting.
It is. The second method involves complex approximations like the Barone, Deci, and Whaley model, which mathematically calculate the exact value of the early exit premium and basically just bolt it onto the side of the BSM price.
Let's talk about the practical side of that, though. Why would someone actually want to exercise early?
It's rare, but it happens.
Because if an option still has time value left, why not just sell the option contract back to the market? Doesn't exercising it destroy the remaining theta?
Usually, yes. You almost never exercise early just to take profits. You just sell the contract.
Yeah.
But there are specific triggers where exercising early is financially optimal.
Like what?
The biggest trigger is corporate dividends.
Oh, okay.
Let's say you hold deep in the money call options on a company and they unexpectedly announce a massive one-time special cash dividend. Option holders do not receive dividends, only shareholders do.
Ah, so you want to be a shareholder.
Right. So the day before the stock goes ex-dividend, which is the cutoff date to own the shares, call option holders will aggressively exercise their contracts early, converting them into actual shares so they can capture that massive cash payout.
That makes perfect sense. The cash dividend outweighs whatever remaining time value they destroy by exercising.
Exactly. Another common trigger is deep in the money put options.
Okay, lay that out.
Imagine you bought a put option on a company with a strike price of $100, and suddenly the company is exposed as a massive fraud.
Like Enron.
Like Enron. The stock plummets to $1. Your put option is now incredibly valuable. But if it has 3 months left until expiration, you have a problem. Your money is completely tied up.
Right.
If you exercise the put early, you force the seller to buy the shares from you at $100 immediately. You get a massive influx of cash today, which you can immediately deposit in a bank to earn 3 months of interest rather than just waiting for the contract to naturally expire.
Got it. So they are capitalizing on the time value of money. Yeah, so we've built a really solid foundation here. Time, interest, and volatility. These are forces we can measure, right?
Yes.
We know when expiration is. We know the repo rate. We can calculate the early exit premium. But the actual moment-to-moment price movement of the stock, that is unpredictable.
Highly unpredictable.
And this brings us to the most thrilling and frankly terrifying part of our deep dive. We are transitioning from the predictable math of pricing into the violent reality of the live market. We are moving from delta to gamma. And gamma is the true engine of market chaos.
It really is. If we use a physics analogy, delta is velocity. It's the speed your car is currently traveling. If an option has a delta of 0.5, the option's price will move 50 cents for every $1 the underlying stock moves. It measures the current relationship.
Okay.
But gamma is acceleration. Gamma measures how fast the delta itself is changing. It's how hard you are pressing the gas pedal.
Oh, wow.
And this is where the fundamental difference between holding a share of stock and holding an option becomes profoundly important for the structure of the entire market.
Let's build a mental model for this so we can really picture it. Let's compare holding 100 shares of stock to holding a rigid iron bar.
Okay, an iron bar.
A share of stock has a gamma of exactly 0. It is perfectly linear. It has 0 convexity. If the stock goes up $1, you make $1. If it goes up $10, you make $10.
Mm.
The relationship never changes. The iron bar never bends. It never stretches. It never changes shape.
That is exactly right. The delta of a stock is always exactly 1.0, and the gamma is 0. But an option is not an iron bar. An option has positive gamma for the buyer. It is a nonlinear financial instrument.
So an option is more like a dynamic rubber band.
Yes, a rubber band.
The more the stock price moves in your favor, the more the rubber band stretches, building tension. The momentum accelerates. As the stock goes higher, your call option's delta gets higher, meaning you make money faster and faster the further it runs.
Yes. The rubber band amplifies the move. But remember the core mechanic we discussed earlier. The market maker who sold you that call option is holding the other side of the trade.
Right.
If you hold positive gamma, the stretching rubber band, they inherently hold negative gamma. They sold you the rubber band, and they are attempting to hedge that highly dynamic, nonlinear, accelerating rubber band using linear, rigid shares of stock, the iron bar.
If a market maker is trying to secure a dynamic stretching rubber band using a rigid iron bar, they can't just set it down and walk away.
No, they can't.
As the rubber band expands and contracts with every tick of the stock price, the tension is constantly changing. To maintain that state of delta neutrality, to keep the tension perfectly balanced, they have to constantly, frantically move the iron bar around.
That is the beautiful, terrible essence of dynamic hedging. And if we zoom out and connect this microscopic action to the bigger picture, the aggregate collective actions of all these giant market makers desperately moving their iron bars around to manage their gamma exposure, it literally dictates the behavior of the entire stock market.
It's that big of an effect.
Oh, it's massive. The necessity of hedging creates two entirely distinct structural market environments.
Let's break those environments down slowly, because this is where the X-ray vision really turns on for you listening.
Let's do it.
The first is what the sources call the positive gamma environment. I like to think of this as the market shock absorber. Walk me through the mechanics. How does a market enter a positive gamma state?
A positive gamma environment typically occurs during calm, bullish periods. It is driven by the behavior of large institutions and retail investors actively selling options to generate yield.
Give me an example.
For example, imagine a massive pension fund holding millions of shares of Apple stock. They are long-term investors. They aren't going to sell the stock, but they want to generate extra income. So they systematically sell covered calls against their massive position. They are collecting that daily theta rent from speculators.
Okay, so the investors are the ones selling the options in this scenario, which means the market makers are the ones buying those options.
Correct. And whoever buys the option holds the positive gamma. So in this environment, the market makers are holding the positive gamma. Their rubber band is working in their favor. The acceleration is helping them.
How does that specific alignment affect their hedging algorithms? How do they manage the iron bar?
It forces them to trade against the prevailing trend. Let's trace the math. The market maker owns call options. If the stock price goes up, the delta of their call options increases. Their position becomes overly long, heavily tilted to the upside.
So they need to trim it back.
Right. To bring their exposure back to neutral, the algorithm must sell shares of the underlying stock. Conversely, if the stock price goes down, the delta of their options decreases. Their position becomes too short. To neutralize, the algorithm must buy shares of stock.
Let me make sure I'm grasping the scale of this. If the market dips, the market makers are mathematically forced to buy the dip. If the market rallies, they are mathematically forced to sell the rip.
Exactly. The market makers are structurally, algorithmically compelled to buy low and sell high on a massive scale.
Wow.
When billions of dollars of institutional capital are doing this systematically, tick by tick, it acts as a colossal shock absorber on the index. It compresses the price action. It actively suppresses volatility.
This completely explains those long, slow, grinding bull markets we see for years at a time. The days where the market opens, goes up 0.2%, drops 0.1%, and just does absolutely nothing.
Exactly.
Everyone complains that the market is boring, but it's boring because a multi-billion-dollar algorithmic shock absorber is actively dampening every single move.
It creates an artificial sense of immense stability. The positive gamma creates a feedback loop of extremely low volatility.
Okay, but what happens when the mood shifts? What happens when the shock absorber breaks and the amplifier gets plugged in?
That's the scary part.
That brings us to the exact opposite scenario, the negative gamma environment.
This is the danger zone. This is where the foundation of the market becomes incredibly fragile. A negative gamma environment occurs when the psychological state of the market shifts from greed to fear.
Okay.
If there is a sudden macroeconomic shock, say a war breaks out, a pandemic hits, inflation spikes, institutions panic. They want to protect their massive stock portfolios, so they rush into the market and aggressively buy protective put options as insurance.
So if the investors are frantically buying millions of puts to insure themselves, the market makers are the ones forced to sell millions of puts to provide that liquidity.
Yes. And as the seller of the options, the market maker now holds the negative gamma. The rubber band is no longer helping them. It is violently snapping back in their face.
How does their hedging behavior reverse in this environment?
It flips completely,
Yeah.
and it becomes incredibly destructive. Let's trace the math again. The market maker has sold put options. If the stock market drops, those put options become incredibly valuable to the investors who bought them.
Right.
This means the market maker's liability is skyrocketing. Their delta becomes more positive, meaning they're accumulating massive, unwanted long exposure exactly as the market is falling. To neutralize this toxic exposure, the market maker's algorithm must sell stock.
Wait. I need to emphasize this. The market is dropping. There is blood in the streets. And to protect themselves, the market makers have to violently dump stock into the exact middle of the drop.
Yes. They are forced to sell into weakness. They are forced to sell low. And if the market violently spikes upward in a relief rally, the math reverses and they are forced to aggressively buy stock at the top of the spike.
Oh my God.
They are mathematically compelled to trade with the momentum of the market, not against it.
They literally become the amplifier. The panic of the investors forces the market maker to sell, which drives the price down further, which causes more panic, which forces more selling.
Yes, it's a terrifying feedback loop.
So what happens when this amplifier gets turned up to maximum volume? Because that is when we enter the realm of liquidity black holes and gamma squeezes. Walk me step by step through the exact mechanical chain reaction of a downward gamma squeeze.
It is a brutal, unforgiving process. Let's break it into steps. Step 1, an external catalyst hits the tape. A bad inflation report, for example. The market drops 1%. Step 2, because we are in a negative gamma environment, that 1% drop causes the market maker's delta to warp rapidly. To stay neutral and shed the unwanted risk, their computers automatically fire off massive orders to sell the underlying assets. Typically, they use ES futures, E-mini S&P 500 futures, to hedge macro risk.
Why ES futures instead of just selling the actual stocks? Like, why not just sell Apple and Amazon?
Speed and capital efficiency. If a market maker needs to hedge a massive portfolio of options tied to the S&P 500, trying to individually sell shares of all 500 companies simultaneously is a logistical nightmare.
Right.
It is much faster, more liquid, and requires far less margin capital to simply short the ES futures contracts that track the index. It provides instantaneous broad market hedging.
Got it. So step 3. The market maker's algorithms dump thousands of ES futures contracts onto the market in a matter of seconds. This immense forced selling pressure pushes the broad market down even further. We drop to 2%.
Which triggers step 4. The further the market drops, the more panicked human traders become. The VIX, the volatility index, which measures fear, spikes violently. And here is where a secondary, hidden force called the Vanna effect kicks in.
The Vanna effect. The sources highlight this as a major accelerant. What exactly is it?
Vanna measures how an option's delta changes when implied volatility changes, regardless of whether the actual stock price moves.
Wait, so the price doesn't even have to move?
Nope. When the VIX spikes and fear enters the market, the implied volatility of all options inflates. This expansion volatility mathematically warps the delta of the market maker's entire portfolio all over again.
So even if the stock price pauses for a second, the mere increase in fear among the traders forces the market makers' algorithms to recalibrate, realize they are suddenly underhedged again, and fire off even more sell orders.
Yes, the fear literally manifests as mechanical selling pressure. It is a pure mathematical death spiral. Price drop leads to gamma hedge. Price drops further. Volatility spikes. Vanna hedge. Price drops further.
Okay, here is the question that I know every single person listening is screaming right now.
You hear it.
If a gamma squeeze is destroying the market, and the bid-ask spreads are incredibly wide, and everyone is losing their minds. Why don't the market makers just pause the computers?
They can't.
Why doesn't a human being look at the screen, see the chaos, and say, let's just wait an hour to sell? Let's wait for prices to stabilize so we get a better execution.
Because they physically and legally cannot. They do not have the luxury of human discretion. Market-making firms operate under incredibly strict, heavily monitored risk limits mandated by their internal compliance departments, their clearinghouses, and federal regulators.
So their hands are tied.
Completely. If a firm's delta exposure exceeds a specific hard-coded threshold, it is considered an unacceptable systemic risk to the firm's survival.
So the selling is completely non-discretionary. It's a biological survival mechanism for the firm.
Entirely. A human trader isn't sipping coffee and making a choice to hit the sell button. The risk management system triggers an alarm and says, we are over our limit by $500 million. Sell 5,000 ES contracts at the market price right the second, or we risk insolvency.
Wow.
Even if the bid-ask spread is monstrous, even if they have to take a massive loss on the execution, they must execute the trade to shed the directional risk.
Which means they completely change their identity in the ecosystem. They transform from being a liquidity provider to a liquidity taker.
Exactly. In a normal, calm market, market makers are providing the bids and asks. They're making the market smooth for everyone else. But in a gamma squeeze, they abandon the bid-ask spread. They are aggressively crossing the spread and hitting the bids of anyone else left in the market.
They suck all the buy orders out of the room like a vacuum.
They do. This creates what we call a liquidity black hole. There are simply no buyers left with enough capital to absorb the relentless algorithmic selling. The floor just falls out.
Listening to this, it reminds me vividly of a short squeeze, like the GameStop frenzy a few years ago, but operating in reverse.
The comparison is highly accurate. A short squeeze and a gamma squeeze share the exact same core DNA. They are both driven by forced survival-based liquidations.
Right.
In a short squeeze, a massive hedge fund is forced to buy stock at literally any price to cover a margin call before their broker liquidates them. In a gamma squeeze, a market maker is forced to sell stock at literally any price to satisfy a risk algorithm before they breach compliance.
In both scenarios, the trader executing the order has lost all negotiating power.
Exactly. And when the biggest players in the market lose their ability to negotiate price, it leads to completely irrational, disconnected, violent pricing.
And during these algorithmic free falls, the sources talk about a phenomenon called the magnet effect. When the market enters one of these liquidity black holes, prices seem to plummet without any natural resistance, but they don't fall to zero. They seem to stop magically when they hit very specific round numbers. Why is that?
They are falling towards strike prices that have massive open interest.
Open interest.
Yeah. Open interest, or OAY, is the total number of outstanding option contracts at a specific strike price that have not yet been closed or exercised. It is a measure of inventory.
Right.
If there is a massive cluster of put options sitting at a specific strike price, say, the 6,600 level on the S&P 500, the concentration of inventory, creates what is known as a gamma wall.
A gamma wall, like a physical barrier built out of options contracts.
Exactly. As the price free falls toward that 6,600 wall, the negative gamma hedging pressure is immense. The market makers are selling aggressively as the options approach being in the money.
Right.
But here is the critical inflection point. Once the price crosses through that 6,600 wall, the dynamics change instantly. Those massive put options are now deep in the money. Their delta maxes out at a value of negative 1.0.
And if delta is maxed out, it can't accelerate anymore.
Precisely. Because delta can increase beyond 1.0, the acceleration drops to absolute zero.
The rubber band has stretched as far as it can physically go.
Yes. The market maker doesn't need to sell any more stock to hedge that specific strike because the hedge is complete. The relentless algorithmic selling pressure exhausts itself almost instantly.
Wow.
The liquidity black hole closes, buy orders can finally step in, and the market finds a hard floor. The free fall stops right at the wall.
Okay, this theory is absolutely mind-blowing. It completely changes how I view a red day in the market. But I want to take all this theoretical chaos and apply it to the actual screen the listener is looking at.
Let's do it.
Let's ground this in real-world, highly specific data. Because the sources provided a deep analysis of specific snapshot in time. March 27, 2026. Let's put our X-ray goggles on and look at this exact day.
March 27, 2026 is a perfect laboratory for everything we've discussed because it happens to be a triple witching day.
Triple witching. I mean, it sounds like an archaic curse. What actually happens on the floor on triple witching?
It occurs 4 times a year, the third Friday of March, June, September, and December. It is the single most important day on the options calendar because it is the day when 3 different types of massive derivative contracts all expire simultaneously.
Which three?
Index futures contracts, index options, and individual stock options.
So millions of contracts representing trillions of dollars of leverage exposure all hit their expiration countdown at the exact same moment.
Yes. It is a massive reset button for the entire financial system. It forces market makers and giant institutions to completely unwind massive, complex hedging positions, roll them over into future months, and reestablish their risk parameters.
That sounds chaotic.
The volume is astronomical, and the market is incredibly vulnerable to gamma shifts.
And the data for this specific day, March 27, 2026, paints a terrifying picture. It shows that the S&P 500, the SPX, fell below its crucial gamma flip point, which the models had calculated to be around the 68875 to 6900 level. Explain the significance of crossing that line.
The gamma flip point is the exact mathematical boundary where the aggregate options market transitions from being a positive gamma shock absorber to a negative gamma amplifier.
Okay.
By falling below 6-day-75, the entire macro market officially entered a heavy negative gamma state. The models estimated the net gamma exposure, or net GEX, at that moment was between -$8 billion and -$9 billion.
I want to make sure the listener understands the sheer violence of that number. What does a net GEX of -$8 billion actually mean in terms of physical trading?
It means that for every single 1% the S&P 500 drops, the market makers are algorithmically forced to sell $8 billion worth of stock into the market just to maintain their hedges.
Just survive.
Right, and if it drops another 1%, they have to sell another $8 billion. It is a cascading waterfall of forced liquidation.
And looking at the charts provided in the notes, the next massive gamma wall, the nearest major cluster of put options that could act as support, was sitting all the way down at the 200-day moving average, around the 66619 level.
So you have the price at 68.75 and the floor at 66618. That empty space between those two numbers is the liquidity black hole.
Wow.
There is very little structural support there. That is the free fall zone where the magnet effect will violently pull the price down toward the 6619 wall as the algorithms just dump their $8 billion tranches.
Let's zoom in from the macro index and look at how this impacts a single recognizable stock. The notes show incredible option chain data for Amazon on this exact same day.
Amazon is a great example here.
Amazon was trading right around $207.67, but looking just above that price, the option chain showed a massive battleground forming at the $210 call strike. There was massive open interest, 908 contracts, an explosive intraday volume of 10,930 contracts trading in a single session. Help me decode those two numbers.
The discrepancy between open interest and volume is the key to understanding the psychology of the tape. Open interest is the existing static inventory. It tells you how many contracts were carried over from yesterday. Volume is the live intraday action. It is how many times contracts traded hands today. When you see volume wildly exceeding open interest at a specific strike, like 10,000 contracts traded versus only 900 sitting in inventory at the 210 strike, it means that specific price point has become a high-tension war zone.
People are fighting over it.
Exactly. Day traders, algorithms, and institutions are aggressively fighting over that specific line in the sand.
Because if the price of Amazon can just push up toward that $210 level, it creates a localized gamma squeeze for the upside.
Exactly. If the retail traders can force the price toward 210, the market makers who sold those 10,000 call options will be suddenly forced to aggressively buy Amazon stock to hedge the rising delta.
Which pushes the price up even more.
Right. This forced buying creates a localized upward squeeze for Amazon, causing it to rip higher even while the broader S&P 500 is falling into a black hole. It creates massive dispersion in the market.
So we have painted a picture of a market that is highly mechanical, completely ruthless, and prone to violent algorithmic liquidations.
That's the reality of it.
If the market is this chaotic, if the institutions managing trillions of dollars are literally being forced by math to buy and sell without human discretion, what is a smart strategy for you listening? How do you manage a personal portfolio when the S&P 500 enters a negative gamma death spiral?
Well, the absolute first step before you make a single trade is truly understanding your exposure. You cannot navigate the storm if you don't know how much sail you have up.
That makes sense.
And the professional way to measure that is using a metric called beta-weighted delta.
Beta-weighted delta. Okay, let's unpack that. We talked earlier about delta being the number of shares of stock an option represents. A zero point 0.5 delta is half a share. What does the beta weighting part do?
It solves a translation problem. Let's say your portfolio is a mess. You hold 100 shares of NVIDIA, 50 shares of Coca-Cola, a call option on Tesla, and a put option on a gold ETF.
A total mix.
Right. You cannot just add those individual deltas together to figure out your total risk. Why? Because a $1 move in NVIDIA is fundamentally different than a $1 move in Coca-Cola.
Because NVIDIA is hyper volatile and Coke barely moves.
Exactly. You are mixing apples and oranges.
So you need a universal translator.
Yes. Beta is a statistical measure of how volatile a specific stock is compared to the S&P 500 index. If a stock has a beta of 2.0, it moves twice as fast as the index.
Okay.
By multiplying each individual position's delta by its specific beta, you translate every asset into a common language. You mathematically convert your entire messy, diverse portfolio into a single unified number, your SPY equivalent exposure.
Oh, that is incredibly powerful. So I can look at my dashboard, ignore the fact that I have 20 different weird positions, and just look at one number that says, okay, right now my entire portfolio behaves exactly as if I'm holding 342 shares of the S&P 500.
Precisely. It gives you an X-ray of your true aggregate risk. If you see the net GX numbers flip negative and you see the SPX heading toward a liquidity black hole, you instantly know exactly how much pain your portfolio will take because you know your exact index equivalent.
And then you can hedge it.
Exactly. You can then buy a single SPY put option to hedge your entire complex portfolio perfectly.
Okay, so beta weighting is how we measure the risk. But what about an active strategy? If the market is chopping around violently, the sources highly recommend deploying something called the wheel strategy.
The wheel.
I want to walk through the mechanics of this because it feels like a way to actually exploit the chaos we've been talking about.
The wheel strategy is incredibly powerful if executed with discipline, specifically because it turns you into the casino. It consists of two distinct phases.
Let's hear phase one.
Phase one. You identify a high-quality stock that you actually want to own for the long term. Let's say Amazon. You sell a cash-secured put option below the current price. By selling the put, you collect premium. You are collecting that theta rent.
If the stock stays above your strike price, the option expires worthless. You keep the cash, and you sell another one. You just keep collecting rent. But what if the market drops? What if a gamma squeeze hits and Amazon falls below your strike price?
If that happens, the option is exercised against you. You are assigned. You are forced to buy the shares of Amazon at the strike price. But remember, you wanted to own Amazon anyway. You just got paid a premium to buy it at a discount.
That's a great setup.
Now you enter phase two of the wheel. Now that you physically own the 100 shares of Amazon, you sell a covered call option against them above the current price. Again, you collect premium. You collect more rent.
And if the stock rises and hits your call strike, the shares are called away from you. You sell them for a profit, plus you keep all the premiums you collected along the way, and then you just start over at phase one. You just keep spinning the wheel.
Yes. The primary goal of the wheel isn't to hold a stock forever for capital appreciation. The goal is to be the landlord of the option chain. You are continuously collecting the theta from the speculators who are gambling on directional moves.
But the crucial application from our sources involves how you execute this strategy during a volatile, negative gamma environment. The notes strongly emphasize two rules.
Very important rules.
You must execute the wheel on Friday expiring options. And you must only trade highly liquid assets. Why Friday specifically? And why is liquidity a matter of life and death if I'm just planning to get assigned anyway?
It is about survival during black swan events. Friday expirations, especially the third Friday monthlies that align with triple witching, have by far the most institutional participation.
Right.
Because the giant funds are trading them, the bid-ask spreads are incredibly tight. You might buy at $1 and sell at $1 oneer. You don't lose your theta profits to execution slippage. As for liquidity, remember the mechanics of the negative gamma liquidity black hole.
Right, the algorithm's sucking all the buyers out of the room.
Imagine you are short a put option on a small illiquid biotech stock. You are trying to spin the wheel, Suddenly, macro news hits and a gamma squeeze starts dragging the entire market down. Your short put option is going to lose value rapidly as the delta expands against you. You might look at your screen and decide, I don't want to get a sign on this biotech stock anymore, the market is crashing. I want to close the position and take a small loss to stop the bleeding.
I want to buy my option back and close the trade.
But because it is an illiquid stock, the market makers are terrified. To protect themselves from volatility, they will have widened the bid-ask spread to a mile wide. The bid might be $1 and the ask might be $5.
Wow.
You will get trapped. You literally won't be able to buy your putback without taking a catastrophic portfolio-destroying loss on the spread alone. But if you are executing the wheel on a massive, highly liquid asset like the SPY ETF or Amazon, the volume is so immense that even during a gamma squeeze, you can almost always get out. The door is always open.
So, as we wrap up this deep dive, what does all of this mean for you, the listener? It means a profound shift in perspective. It means that the stock market is not a casino based purely on random luck, and it's certainly not always a rational weighing machine perfectly pricing in corporate earnings.
No, it is a highly engineered, deeply mechanical machine.
And hopefully you now understand the hidden gears turning beneath the surface. We have covered incredible ground today. We started with the elegance of the BSM model, realizing that an option isn't magic. It is just a synthetic, dynamic recipe of leveraged debt and stock.
We expose the necessary illusion of risk-neutral pricing, the frictionless vacuum that allows the math to work.
We felt the ticking clock of theta, the daily rent you pay on the market maker's repo debt. We watched delta shift and gamma accelerate, acting as a massive shock absorber to suppress volatility in quiet times and transforming into a terrifying algorithmic amplifier during a panic.
And we traced step by step how that amplifier leads directly into the death spiral of a gamma squeeze, creating liquidity black holes that culminate in the massive volume of triple witching.
The Greeks, delta, gamma, theta, vana, they aren't just academic concepts buried in a graduate-level finance textbook. They are the literal mathematical blueprints dictating how giant multi-billion-dollar institutions are forced to buy or sell the very stocks you hold in your portfolio.
Which brings us to a final lingering paradox that I want you to really think about after we sign off.
Let's hear it.
The entire Black-Scholes-Merton model and the multi-trillion-dollar algorithmic hedging industry that has been built on top of it over the last 50 years relies entirely on the assumption that markets are smooth, continuous, and highly liquid. It assumes you can always hedge.
Right.
But as we have explored today, in a negative gamma squeeze, the very act of hedging itself, the forced mechanical selling to stay delta neutral, is exactly what creates sudden, violent price gaps and actively destroys the liquidity in the market.
The cure causes the disease. The attempt to mitigate the risk creates the crash.
Exactly. So here's the question for you to mull over. If the ultimate safety net for global financial institutions actively destroys the exact conditions required for that safety net to function, is modern risk management actually the market's biggest systemic risk?
That's an incredibly chilling thought to leave on. Thank you so much for joining us on this deep dive. The next time you open your brokerage app and look at an option chain, or the next time you see the market inexplicably drop 2% an hour while the financial news anchors scratch their heads, we hope you look at the screen with your new X-ray vision. You aren't just looking at the surface narrative anymore. You can see the jagged white lines of the mechanics underneath. Until next time.